Dr. Roubini, just looking a little bit more immediately in terms of what we can expect in the coming months, what could be the next shoe to drop? Are there specific areas that we should be particularly watching or particularly concerned about?
There are many of them. I think the process of deleveraging is going to continue. You could have, 1,000, if not more, hedge funds going bust all at the same time. None of them is as large as the ledger average as LTCM was in '98, but if 1,000 of them go out of business, this process of selling distressed assets in liquid market could continue. That's one source.
That's in the coming sort of few months in particular?
Yeah. I mean, the redemptions and now the reduction of availability of leverage to overnight repo implies that many of these leverage institutions have to contract. Another source of stress is, emerging market economies. There are about a dozen of them that are on the verge of a potential financial crisis, from emerging Europe, Latvia, Estonia, Lithuania, Hungary, Bulgaria, Romania, Turkey, Belarus, Ukraine. In emerging Europe, places like Pakistan, Indonesia, or Korea. In Asia, places like Ecuador that just defaulted, Argentina and Venezuela in Latin America. Some of these countries could go in trouble, and there could be contagious effects to other financial markets and other emerging markets. And I would not be surprised if other skeletons come out of the financial system. We've had this Madoff scandal. How many other institutions out there are doing this kind of Ponzi games?
Right.
That institution was supposed to be regulated. 10,000 hedge funds are not even regulated. So, you don't know. There is no transparency. It's all totally opaque financial system. So I see significant sources of essentially financial distress still coming up. These credit losses are going to spread from, as I said, mortgages to commercial real estate, to credit cards, to auto loans, to leverage loans, to industrial and commercial loans. There is still this time bomb of the CDS market could blow up as corporate default rates are rising. There are many sources of financial stress.
Right. The other area of concern that's particularly become the focus recently is the dollar, following the Fed's cut in the Fed funds effectively to zero. What's your outlook for the dollar?
There are different forces. In the recent months, the dollar was strengthened in part because there was this flight to safety, unraveling of carry trades, and the dollar had become actually a funding currency for these carry trades, as interest rates were very low. Of course, also the bleaker economic outlook in Japan and Europe implied the relative interest rate differential and growth differentials were becoming less bearish for the dollar. But looking ahead, I see a dollar weakness. I see dollar weakness because effectively the Fed is easing money like crazy. We might monetize this fiscal deficit. We'll have large twin fiscal and current account deficits as our fiscal deficits become larger. And we'll have also a very weak US economy and a weak financial market. So over the medium term, actually, the dollar has to weaken. If the US has to grow back to potential and consumption is going to grow less than income because we have to rebuild savings, other components of demand have to grow faster than income, the main one being net exports, that implies a weaker dollar over time.
Right. When we spoke several months ago, I think you still invested most of your own money in equities. Do you continue to put your money in equities, or where do you put your money?
Well, I've never bought in my life or sold an individual security.
Yeah.
I save for the long run, and my savings, my 401k, is all in equities globally, passively managed funds, not actively managed. And I think that for the long term, that's the right strategy for a small, retail investors. But if you are a sophisticated investor, you're managing money. And my view is that you have to stay away from equities and other risky assets. I see another 15 to 20% downside risk for US and global equities because in the next few months, macro news are going to be much worse than expected. Earnings news are going to be much worse than expected. We'll have other skeletons coming out of the financial system. So I don't see this as being the bottom of the market. Yes, there is a bear market rally, but like previous ones, it's going to fizzle out. So I'm concerned about equities, I'm concerned about credit, I'm concerned about commodities falling another 15, 20% given a severe recession. I'm still concerned about emerging market asset classes. I think that cash and cash-like instruments like safe government bonds are still the safer bet for the next few months. Down the line, towards the end of 2009, if we see the light at the end of the tunnel of an economic recovery, if and when we see it, maybe it's time to go back into risky assets, but not in the short run.
Thank you very much.
Pleasure being with you today.